August 2024, the summer, American politics in full swing, the Olympics in full swing. That was a hell of a start to the Olympics, huh? You see the guy with his ball hanging out in the opening ceremony? I got to tell you, the world can't get any stranger, can it? But on this podcast, I have good conversations. And even though I might have some strong political views, some strong economic views, I generally just like good conversations. So today, as we start August 2024, reaching back, let me give you two perspectives. One, from a world-class tech entrepreneur. The other, from a fantastic trend-following trader. I hope you enjoy and see you again next week. My guest today is an entrepreneurial legend, Nolan Bushnell. Nolan founded Atari, Chuck E. Cheese, and 20 other companies. He's never stopped. He's a serial entrepreneur. But how cool is that? A conversation with the guy that started Atari. There's probably no other invention. In fact, I know there's no other invention that shaped my life early on, before the age of 10, than an Atari. That was it. It was an Atari. And all these years later, I get to talk to the guy who invented the damn thing. Podcasts are awesome. Conversations are awesome. My guest today, Nolan Bushnell, easily one of my favorite conversations of all time. He's awesome. Without any further build-up from me, without any further fanboy from me, enjoy this conversation with Nolan Bushnell. Do you feel like when you look back on your life, some grand plan, or were you just a guy that was kind of the Bayesian step, and just follow along?
I think my life has been a series of happy accidents that were not really planned a priori. For example, I was probably the only electrical engineer that put himself through college working in an amusement park and then at a university that had one of the very earliest video screens connected to a big computer. And I played a game on it, written by an MIT student, and thought to myself, gee, if I had this at my amusement park, it'd make money. Then you divide 3 minutes for a quarter into $1 million computer, and math doesn't work. But graduated, went to work in Silicon Valley, got good digital skills, and one day I said, I think I can make that cheap. I did, and it did. And therefore the video game.
I guess I want you to talk a little bit about yourself, the decision making. A lot of people can make those observations at that time. There had to be somebody kind of leading the pack. Look, as a Gen X guy, 1977, 78, I can still remember the room. I can remember the TV. You've got a whole generation of guys, essentially, that grew up on the 2600. I guess what I want to drive at is for you to make those observations at that time, to start to connect those dots. What was different about you? Did you have friends and family that were thinking like that, or was it just something in you?
I'd always been a tinker. I was a ham radio operator when I was 10 years old, and I made money repairing TVs as an 11 and 12-year-old.
That's pretty advanced, though, as a 10-year-old.
Well, I think there's a little bit of Carney in me because it actually wasn't that hard. All you had to do is figure out which tube was going out, and you change the tube. It wasn't rocket science. It was more balls than talent.
I have the word balls written here on my notes after preparing for you. I thought, okay, balls is the word that describes this guy.
I really have asked myself the question, are entrepreneurs made or are they born? And I don't know. I think maybe I was born because I started out at a very young age figuring out that if you take a job, somebody is paying you a salary, that means that they're making more money than you are. So if you can go direct to your customer, that's a better way. And it's kind of been part of my mantra ever since.
So at such a young age, repairing TVs, having this entrepreneurial bent, thinking perhaps you were born with it, there really weren't friends, family influences that were pushing you. It was just you, the curious kid, the whimsical kid, interested, diving in. That was the drive.
I think it was a lot of that. I mean, my dad was an entrepreneur. He owned his own construction company. I mean, he worked for himself. That's a pattern that seemed normal to me. I think curious is a very good way to describe me all my life. I've tried to understand the nature of the world. I've always had a scientific, technical bent. It's served me well. I've always liked games. Like I was an avid chess player as a young man. I actually played on the university chess team. I think the combination of kind of viewing life as a game, figuring out what the rules are, and then figuring out the meta rules, where you not only figure out the game, but you figure out how to break the game.
I'm going to take you around a lot of different topics. There's a big picture way of being that I think you can elaborate on that I've seen you talk about. The idea of the flow state, getting into the zone. I don't think people necessarily think about this a lot. Maybe they think of Michael Jordan. They don't necessarily think of Nolan Bushnell. You had to put yourself into a frame of mind of intense focus to achieve certain tasks. If you're going to take on this task, whatever the task, and we'll talk about some of the things in your life, you didn't have time to just go play games, eat dinner. I mean, it was an intense focus. You loved being in that place.
I do. And actually, as a kid, when I get focused on something, bombs could go off around me and I wouldn't notice. And it used to irritate my mother and my sisters, and later on, my kids. Daddy, come on.
That's part of the magic. For other people to understand that one of the reasons, perhaps the biggest reason, that you've had so much interesting successes in your life is that you could do that.
I think it helps. No question about it. I mean, I like to ask people, how many all-nighters have you spent in your life on a project? A lot of people look at you like you're crazy. An all-nighter? I can think of maybe 100 that I've spent, where just 24 hours was not quite enough time.
You mentioned being back in school, seeing some of the early video games. If my dates are right here, in 1969, even though I don't think it was necessarily a profitable venture, in 1969, you had a computer space game, 3 million in sales. This is a long time ago. You set the direction and went that direction. When did you first know deep in your bones, even if you were not yet there, when did you know deep in your bones that myself, Nolan, I've got a chance to be at the tip of this spear. I've got a chance to be the guy that leads this nascent new industry. When did you know that you had a chance?
Probably late 1968. In fact, it was Thanksgiving weekend. I, at that point, had an epiphany of how to build a video game out of discrete MSI. I had it running by Christmas.
In my life, okay, writing some books and doing some interesting things, sometimes when you know you're doing something first, that feeling helps to put you into the flow state because you just block everything out. You're just like, okay, I'm on this adventure. I'm going this way.
I can't say that I had anything other than I knew this was going to work and I knew that it would make money. I just kind of knew it. Then you just solve problems, one after the other, after the other, after the other. Sometimes the problems get bigger and sometimes they get smaller.
Well, it's an interesting way that you phrase it, problem after problem after problem, meaning there was a process that you had to go through to get to the outcome. People can just imagine, hey, I started Atari. I mean, maybe they could have some vision like that. You look at it, like, hold on, you don't know all the steps that went into that to get there.
Remember, Atari started before venture capital was a thing. In some ways, I think getting the video game going was easier than figuring out a way to build a company with no money. I mean, I was chasing cash flow. The first 3 years of Atari, it was a cash flow chasing construct because when you build a growing company, you never have enough cash. You're buying furniture from Repo Depot. You don't have a sign because you're spending money that you don't need. It was a chase.
You say no VC before Atari. Today, kids, they've got an idea, all kinds of money is thrown at them. When can you recall that your peers in Silicon Valley starting other ventures started to get VC? I don't know the answer. I'm just curious.
We got VC money 3 years after Atari started. I think I was Sequoia's first investment. The real start of Silicon Valley venture capital was a guy named Arthur Rock, who basically funded Intel. Bob Noyce and those guys, they were all working at Fairchild. And Fairchild was they had no shares. They were just wage slaves. And they thought they had something. And they all took a leap and left Fairchild and started Intel.
When you're talking to perhaps young people today, what are some of the lessons that you can still give people that really resonate? How do you look back now? You're a guy that started 20 plus companies. Atari was an early start, but you never stopped. When you reflect back and you want to provide wisdom, what kind of internal conversations do you have when you look at the landscape of entrepreneurs and when you look at the landscape of the world right now?
I suggest that if you're a 16-year-old, get a lot of different jobs, flip hamburgers, drive an Uber. It takes you 3-4 months to learn 90% of a job. Do a lot of different jobs. Get a lot of experience in life because you never know where that nuanced learning can be applied to something else. Because innovation is about synthesis. Take something that's there, mash it together with something that's also there, and you end up with something new. There are too many kids who graduate from college never really having a job. And I think that's very short-sighted.
When you start this conversation, you say you're in your lab, and I can't see all the details. For people that are listening, it kind of looks like a professor, mad scientist, pretty eclectic, right?
Oh, very.
The images that people want to portray online these days, it's like this manicured this, and it's not real. It's not the real world. The real world is messy and it's interesting and it's complicated. We want to put a paint job on everything and varnish it, but that's not how it is.
Well, if you're looking at what I'm looking at, I basically got 4 giant monitors right here. So I've got kind of a wall of monitors, and I've got stuff going on up here, and I've got stuff going on down here. I've got my calendar over here, and I've got you here.
Now, what are you doing with a wall of monitors, if I may ask?
Well, I've got projects. You know how I start a company? I start a PowerPoint deck, though I use Google Docs now. When you think about a company, you have to think about marketing, people, finance, projections, technology. The best way to do that is think about it as a prezo. And I kind of fill in the blanks. I mean, I've done it enough times that I kind of know where all the blanks are. And then you have something that if you want to go out and raise money, you've got the bones for it.
Are you 80? You just turned 80?
Just turned 80.
Okay. I can look at you. I can feel the energy. People can feel it in your voice. People are listening. They might say, that guy sounds like 40 years old or something. The typical mantra is, go retire and sit around and whatever. Obviously, that's not your cup of tea. For those people that want to think like that, give them the other side about why you go, go, go.
Well, I like statistics. And the act of retirement shortens your life by 7 years. Been shown over and over and over again. Now, I don't think it's all causal, because I think some people who retire may have some health issues to feed into that. But at the same time, I think we're designed genetically to be problem solvers, to be on a quest. That's kind of my logical thinking. But in reality, I think projects are fun. I've got 4 projects I'm working on right now. I've got an education company called Exadexa. I'm going to see if I can't gamify education. And I've done enough research and testing that I believe I can teach 100% of what kids learn in high school in about 6 months using software.
So the 4 years reduced to 6 months.
Yeah, with better outcomes and better retention.
I think intuitively, most people could probably agree with that because you can think about all the wasted time that goes on in school. I was bored out of my mind.
Yeah, most kids are. Let's go back to the flow state for a minute. The flow state is actually kind of like the learning flap. If you're in the flow state, you're learning at maximum speed. And so if I can gamify curriculum, if I have a game of chemistry, you can learn more chemistry faster than you can shake a stick at.
I'll share with you a story. This goes back some time. My nephew is currently playing football at the University of Virginia, but I can remember when he was a 3-year-old boy, he was mastering Mario Brothers on the first Nintendo. He was going to YouTube and watching assorted videos to show him the hacks. He was 3 years old, completely zoned in, mastering it, using YouTube. You know, we walk in, he's watching YouTube. There's some guy drinking beer, cussing. My 3-year-old nephew is learning how to play the video game from that. That's probably some of his most important learning lessons versus what they were probably showing him in kindergarten and first grade a couple years later.
No question about it. My youngest son, Wyatt, I have a great picture of him with a bottle in his left hand, a pacifier in his mouth, and a diaper, mouse in his right hand, totally focused on the screen. And he'd say, I'm going down, I'm going to work with Dad. And I had another computer set up for him, and he was playing Pajama Sam as a 2-year-old, just barely able to talk. And he said to me, Dad, I could do better at this game if I knew how to read. I just think that's precious. And right now, he just turned 28. He and I are both Aquarians. He's got a software company and made $1 million this year.
That's awesome. You know, I could think back, so 77, 78, I would have been 9 or 10 when I played the 2600 for the first time. For my life, if I look back on my life, I don't think there was anything more important than learning how to master the games that kept coming out on the 2600.
Yeah.
The most important thing was to figure out those games.
Well, I have 8 kids, and each one of them had a different technical experience based on their birth order. I can remember that when my oldest son was in first grade, second grade, that was when I bought my first Macintosh and showed him how to do HyperCard. And he made his first game at 8 using HyperCard on the Macintosh. You know, 8 kids, I can really see the impact of technology. All of a sudden going from 300 baud modems to the internet. These are big steps.
Let me take you back in time a little bit. You brought up the Macintosh. About 5, 6, 7 years ago, I was leaving Saigon to go back to America for a trip my parents were visiting. I was sitting in the business class lounge at midnight, and some guy tapped me on the shoulder and wanted to use his splitter to share the electrical outlet with me. Okay, this is like 2015 or 16. He's right behind me, like a foot away from me, and I looked at him, and he was kind of graying hair and a little portly, and I looked at him and I said, yeah, you can share my splitter with me as long as you give me a selfie. And he started laughing because no one else in that business class lounge of 100 people knew that was Steve Wozniak. What a great story, because it's a great lead in to you, because at some stage of the game, you hired him, correct?
Kinda. I hired Steve Jobs and put Steve on the night shift because I knew that Woz hung out with Steve, but he was working full-time at Hewlett-Packard at the time. I used to say by putting Steve on the night shift, I hired 2 Steves for the price of one. When they did break, Woz did all the heavy lifting there.
He was the technical genius there, I'm pretty sure.
Steve Wozniak is a savant.
He could get into the flow state as well.
Oh, man. I'd be willing to bet he's one guy that's maybe had more all-nighters than I have.
That story I just told you, the funniest thing is after I took the selfie with him, he turned around and we didn't talk anymore or anything. That was all we talked, to share the electrical outlet. And my father looked at me like, why are you taking a selfie with this chubby guy in the business class lounge at 12 a.m.? What are you doing? I think it's also a great example, though, when you bring up the Macintosh. If I look at your career in whole, so many different ventures. You've had some tremendous successes, but you've also had some failures. That's normal. That's another thing that's not taught to young people today. People today are trying to be perfect, and they're not taking any risks. Talk to success and failure and taking risks. And how did you understand that equation as a young man, that it was okay to fail?
It's a game. You're going to lose some of your games. And in fact, when you lose a game, you learn more than when you win one. In my analysis, my successes have been right time, right place. My failures have been wrong time, wrong place. The timing of things is really, really important. That's why today I have what I call the marinade pile, where when I get an idea for a business, I create my little PowerPoint and I put it on the shelf and let it marinate. Because if you only have one idea, there's only one time. Now, there's only one place. Here, if you've got a month, several, all of a sudden something happens in life and you say, right time for plan B. Or maybe somebody comes along that is the perfect employee that can catalyze the business. Right time, right person. By being willing to be patient a little bit, increases your probability of successful outcomes.
You could put that on a t-shirt.
I think so.
When you say to me, hey, Mike, I can take the 4-year high school experience, reduce it to 6 months. Well, that statement on the t-shirt is the start of getting there in 6 months. It's one of the starts.
It was actually a longer story there. I had an education company before that failed. I had the right technology, but I had the wrong marketing plan. Breaking into the school system is really, really tough. COVID did an interesting thing. It put kids at home with their parents. All of a sudden, the parents started to see what the kids were actually learning and not learning. And so the openness for parents to get engaged with tutors and online learning all of a sudden increased by an order of magnitude. I'm taking all my knowledge from the failed company, restructuring it and putting it into Exadexa.
Let me get you to clarify a little bit about your perspective on subjects. I'm sure this could be thought of as controversial. It's not really intended that way. If I'm analyzing a guy like you and I'm studying you and I'm looking at your life, okay, here's computer science, here's math, here's entrepreneurism, marketing, sales. That stuff's not really controversial. It's like bread and butter for learning. It does seem like today that we're spending a lot of time in education on what I would call political subjects, where the young kids, instead of just getting the basics all down, can really go attack the world and they can take whatever political position they want later on in life. It seems like we're turning education into something where instead of creating more Nolans, we're creating kids that are memorizing assorted philosophies from whatever group.
I think a good word for it would be propagandized. Yeah, I think that public education in America is very off track. And I see that as a really good opportunity because the world is full of smart people and fools. You're never going to get rid of fools, but there are enough smart people that want to do better for their kids, who get past all the baloney that becomes popular, fashionable, and whimsical. That's enough. You can never build a business that caters to everybody. The height of Atari, we probably only had a market penetration of 20, 30%.
Hey, when you reflect, as you bring up Atari, when you reflect on the path of video games over the last 50 years, back in the day when you were playing Pong or Breakout or Super Breakout or whatever, I didn't think to myself, oh, this is too basic. It was fun. Everyone loved these things. We reached a stage, I think, somewhere in the 90s or early 2000s where things became really blood and guts, a real transition. It lost me. Like, I had fun with the Nintendo games. I had fun with those as an adult, playing those Mario Brothers games. But then things shifted, and I was like, well, that's not very interesting to me anymore.
Well, yes and no. What happened is you cannot talk about the video game business. They're video game businesses. And at the time that it was going blood and guts, there was also Candy Crush and puzzle games and things that you could play on your cell phone. There was a bifurcation, trifurcation. There was a split of things that some were puzzle-based, some were action-based, some were conflict-based. Choose your poison. Each of those kind of represented a different business, different philosophy, different monetization strategy. And that's okay. Not everybody likes rom-coms in the theater. You know, I just rewatched Twin Towers and Return of the King, which was just a great movie, and it still is. Does my wife like it? No, not at all. Taste is fun. And long live the difference.
I think another thing that I find interesting about you, especially now, because maybe you didn't feel this when you were younger, but there is a certain endurance to you, Nolan, the entrepreneur. There's a certain endurance. Was that early successes that kept snowballing into other ventures and just keep going? Speak to the looking back on life and looking forward to this idea of endurance, because it sure seems like you have it.
I think I've always had it. This has actually been a question that I've been asking is curiosity made or born? Somebody who's not curious, can you, through a series of actions, can you teach them to be curious? Or is it a state of being? I don't know. I'd say that my first driver is curiosity more than anything else. I just kind of like to see how things work out.
Would you put skeptical as a synonym for curiosity, or do you see them as different?
Very different. I think that there's optimism, there's self-confidence. Self-confidence, definitely, you can build. Success breeds self-confidence. Curiosity is something that is, if you have it, I think it's quite durable.
It's fun, too.
Oh, no question about it.
Fun has been a huge driver for you.
No question about it. And humor. If I can't turn things into a joke, I consider myself a failure. Yuck it up. And all my kids, they talk about dad jokes all the time.
I want to take it back to something you brought up, the idea of education going from 4 years to 6 months. We don't have all the time in the world to get into the nitty gritty, but give people a breakdown of how, big picture wise, you get from 4 years of high school to 6 months, and you pack the same or better educational content into that 6 months. How do you do that?
With Brain Rush, we had a series of lessons that are interactive, put you in the flow state, and taught Spanish vocabulary. It was tested in a Philadelphia school. They had 4 Spanish 1 classes, 2 of which used our software for basically 20 minutes, 3 days a week. So it wasn't a big part of the Spanish 1 curriculum. 2 of the classes didn't. When it came to Spanish 2, they could not mix the classes that used my software with the classes that didn't. Because my kids had a working vocabulary of 2,000 words, and the kids that didn't use my software had a working vocabulary of 150 words.
At the root level, the opportunity you see is when you analyze public education is from the ground up. It hasn't changed, it hasn't deviated, it hasn't improved for all these years. My personal opinion, when I look at public education, to me, it seems like an institution that perhaps first and foremost is about creating jobs for the teachers and the administrators versus getting the students educated.
No question about it. At a cocktail party, you'll get in conversations about education, and somebody will say, why don't we pay the teachers more? And then I say, why don't we give bonuses to the good teachers? Well, teachers union don't like bonuses. They don't like outcome driven. But more than that, let's do shop floor analysis. State of California spends approximately $11,000 per high school student per year. The average high school class is 32 kids. For the ease of math, that says that classroom, that class of kids, has a budget of $350,000 a year. Now, I know that the rent's free because those are bond issues. That's on a different scale. We know the teacher makes $60,000 a year. Janitorial, heat, lights, maybe $10,000. So let's say that there's $100,000 pays for the teacher, pays for all the other stuff. Where'd the other $220,000 go? LA Unified has 1 million square feet in downtown Los Angeles. No teachers, no students, only administrators.
We could find this across other areas of American life, but it's sad that whereas I'm having a conversation with a guy, who is like, hey, I'm going to have to kill it to eat it. I'm going to take this risk. I'm going to take this chance. I don't have the security. The idea that we just have these systems that we're pretending are about educating kids and it's just about jobs is just, oof. I salute you for taking shots at the system. for trying to improve it?
Well, one of the things I'm going to do is I'm going to create some competition to you because the nature of the world, kids need to have full-time babysitters all day while their parents are at work. So even though I can teach kids so much faster, what does that really mean? I'm going to teach them more. They're going to know how to write a play. They're going to act in it. They're going to have their own podcast. If they're in English, they're going to have to write a paper and then put it on Amazon and see if they can sell a short story.
Well, the interesting part you just said there, see if they can sell a short story, because when it comes to life, not necessarily everyone experiences this. I've had the chance to experience it and I love it. But when you can create something and you get compensated for it, the bond that happens,
oh yeah,
it can't be broken.
I've also written a book called The Future of Education, along with a PhD in education. I've got a whole manifesto and process of what I think I can turn schools into. Full labs, experiments. Everybody who graduates from my high school will know how to program a software. They'll be able to do an iPhone app. They'll be able to do a podcast. They'll be able to interview people. They'll be able to debate intelligently. They'll be able to write coherently. They'll be able to create an experiment in electronics, in chemistry, in physics. They're going to have a full grasp of accounting principles, not just balance the checkbook. They need to know what the difference between a balance sheet and a cash flow statement is. Economics. When I talk to kids today who are 17 years old about economics, it's frighteningly silly. They don't know how the government works. They don't know how taxation works. They don't even think about taxation. They don't understand Social Security. All of this is life skills. They should at least know a lot of the things about that at the ripe age of 17, 18.
I think if you had most parents listening to you, and you're not the only man that can say what you're saying, but you're saying it on this podcast, but you've got other peers out there. I would back things you're saying for sure. If parents allowed themselves to hear this kind of a message versus just assuming that the typical public school is going to do the job, if they allowed themselves to hear your message, I think a significant number, well over 50%, would side with the direction that you're pushing versus the direction that's producing administrators and all these jobs, stuff that doesn't tie to their kids' future happiness and success.
Maybe. Here's the conundrum. The best thing you can do is an existence proof. Theoretical converts some people, not as many as you think. Early adopters, the point of the spear, it's lonely up there. You can postulate, and then as you get closer and closer to backing up with empirical evidence, that's when you start the groundswell. A lot of people know things are broken. There's not a lot of people who are saying, this is how I'm going to fix it. That's the whole bigger problem. Do you want to know one of the things that just boils my goat? Student debt. If you think high school at $11,000 per student is too much, try $70,000 a year. They're not spending as much time in class in college as they are in high school. Student debt is the closest thing to child abuse that I've ever seen. Inducing kids to take on debt for a degree that is marginally valuable is criminal.
What's really interesting about that point is I escaped, look at the word I used, I escaped college and grad school by 1994, and I had no debt. I went to good schools, whatever, but I had no debt. What you're talking about is something that's unfolded, frankly, in the last 27 to 28 years.
It emboldened the universities to start jacking up prices because all of a sudden, normal market factors no longer accounted. And there was this feeling that a college degree was good enough to pave the way. I mean, if you talk to any Starbucks barista, most of them college graduates because they got junk degrees and they got student debt. The number of degrees that are just trash right now are just monumental. And it's part of this political thing. There's a lot of waste and a wasted life. What that means to a lot of kids, they're delaying getting married, they're delaying buying a house. There's a whole pernicious cycle that's generated by the very people that should be having children and raising a family and having a good life. It's stopped because all of a sudden they've got this crushing load on their back. Not to say if you got $200,000 in debt, it's kind of harder to start a business, to be an entrepreneur.
The funny thing is, too, is the promise, the quote propaganda that's been thrown upon the kids is you need to have this debt to go get a regular job. You clearly don't need this debt to try to become the next Nolan Bushnell. You don't need that debt to do that. It's a mindset issue where people have been convinced they need this to even start their life. And they're starting their life with, as you say, $250,000 worth of debt.
Yeah.
One last thing I wanted to bring up. We talked about Macintosh. You talked about Apple briefly. You had a chance back in the day to make an investment in Apple. And it's kind of a famous story. You know, you kind of joke about it a little bit.
When I'm not crying.
When you're not crying. Speak to that, because people might hear that and they think that was just an awful decision. Okay, in hindsight, when you're a guy that's making decisions, making choices, not everything's going to work out. You've got this interesting life where a couple guys that helped you on some of your early games, started this crazy company. So that's crazy outlier. Sometimes you make the best decision you can. That's the way life unfolds. But speak to that issue.
The story is I was offered a third of Apple Computer for $50,000, which I turned down. There were 3 mitigating factors. Even though I'd sold Atari, we were working on our own personal computer, and I was still chairman of Atari at the time. And so I felt there would be a conflict of interest. That's one. That wasn't a huge one. The second issue was I didn't believe that Steve had the people skills to be a good CEO. As it turns out, I did him a favor because I wouldn't have had the time that Mike Markkula, who was the first president of Apple and did put money in, he mentored Steve and seasoned him. I wouldn't have done that, wouldn't have had the time. And so in some ways, I think I might have saved Apple by not investing.
We were talking about the idea of creation, and I would just love your perspective on this. This concept of NFTs in the last couple of years, I can go online and I can see that people that created the video games that ran on your system and other systems back in the day, those ROM cards get thrown around the internet and whatnot. It's unfair, because the creators don't get compensated for it. But if we can ever get this digital technology down right, talk about the opportunities for young people in the future to potentially create something in the digital space and control it and be compensated for it and protect yourself. If we can get to that, I would love to have that feeling of my products can be protected, I can be compensated. Well, if we can get that right, it'll be quite exciting.
The blockchain world is one where I have some issues with blockchain as a store of value. Savings account, having your net worth tied up. I believe smart contracts and seamless value transfer under some kind of a rubric of not only control, but royalties and what have you. I can't think of anything better than the crypto world. I personally believe that proof of work economics will fail long term. Proof of stake has not been proven to be secure at this point. I think it will be. And I think proof of stake will save it. But I don't believe the proof of work is long-term possible. The cost of subsequent Bitcoin mining, it's a little bit of a Ponzi scheme. The minute it costs more in energy than you get from the tokens that you mine, the wheels come off. But it doesn't even have to get there. It just has to get to the point where it looks like it's going to, when the wheels come off. And we're closer than you think.
As we wind down, I got to give a shout out to Brad Rotter for introducing us. One of my books was about this famous Chicago trader back in the day. Brad was the first investor in this particular trader. He's touched so many different areas. I don't know how he gets around so much.
Brad and I have hung out a lot. The family farm is kind of like the Bohemian Grove. We've gone there a few times, and I think he's just a terrific human being and smart as a whip, prescient in many ways.
I feel fortunate to have had a chance to know him. Nolan, great stuff. I got to tell you, I would love to see your book on education in the future. If you would like to potentially reappear to talk only education after I have done my deep dive to know where you're coming from on education, I think I already have a general idea, and I think we're on the same page. If you do have an interest in the future, you're always welcome to come on and talk that subject, because I can tell it's near and dear to you.
It really is. I've got another one, though. I've designed a new arcade. The arcade business kind of went out of fashion when home games were equivalent to what you could play at the arcade. The arcade business kind of went away, devolved into games that give tickets called redemption. I've got an arcade that's full of games that you can't play at home. Some new fun stuff that I think will be very interesting. Hope to have the first one open in June.
Everyone that knows how you pursue things, unexpected advances and cool stuff, I'm sure everybody is curious to see what will happen.
Well, got to keep trying.
Is there a particular website that you give out to share with people about what you're up to right now?
I kind of like to wait until things are, I call them three-quarter ass instead of just half-ass.
Well, that is a perfect ending point. They'll have to wait till we get to the three-quarter ass versus the current half-ass.
Right, exactly.
I appreciate you coming on. Thank you for your time. Cool stuff. Again, you're welcome anytime to talk anything.
Let's do another one in 6 months or a year, no matter what.
Sounds good.
Okay, be good.
My guest today is Nigel Kalajian. He is the guy that runs Quest Partners LLC. His second appearance on the show. Maybe this is the third, I'm not sure, but at least the second. Nigel runs a fund. He is a modeler. He's a trend-following guy. He understands systems. He's got a great perspective on the big macro view, but he understands tail risk, and he understands where we are today. Look, if you want steady returns, consistent returns, essentially fake returns, this is not a conversation for you. But if you have your eyes wide open and you want to learn something, Nigel brings it. Without any further delay, let's jump right into my conversation today with Nigel Kalajian. I want to share with you a story that happened to me. I was in an event. It was a typical event, many of these things that you've seen, a lot of hedge fund managers in the room, a lot of bankers in the room, some pub-like setting, everyone's drinking wine or whatever. I started talking to this one hedge fund guy that I knew. This was about a month ago. And I said, so how are you guys doing? He goes, well, relatively. And then as he's saying the word relatively, before I even say anything, he's looking in my eyes and he's going, oh shit, we're not doing good.
Yeah, I know. That's how it goes, man.
I'm going to let you be the professor here for a second and explain these two words that sync together, absolute and relative. And I find when I was thinking about this in advance of our call, I was thinking relative is almost a way to say, don't look at me for performance, but damn it, I'm going to take your fees. I'm going to take your money and I'm going to take your fees.
I would say don't get me started on the hedge fund industry, because my perspective on the hedge fund industry, it's easily replicable. It's effectively a shortcut on the S&P. Nothing is going on. You've got 2-3% of alpha to the S&P. The S&P drops. You realize that you're actually correlated. You realize that you have much more risk than you ever thought. You realize that you can have much bigger drawdowns than you thought compared to the volatility of the hedge fund. So hedge fund is a vehicle where the correlation to the markets is effectively hidden. by hedging the main risks, but you're also taking typically liquidity risk or other types of risk. The vol seems low, the correlation seems low, the drawdown seems low, but it's effectively you're getting paid for tail risk. Markets drops, then you realize that you're effectively much more correlated to the market, that your risk is high, and then you can have drawdowns which are very large multiples of volatility.
To break it down, though, at a real simple level for people, because there's going to be sophisticated people listening, people that are kind of new, but this word relative, it's quite amazing because it really means I'm beyond boringly average, but somehow or another, Wall Street has taken the word relative as some wonderful descriptive adjective about how great they are. And relative doesn't mean that.
The hedge fund fees are very high compared to returns that generate. The alpha is explainable by things that are effectively easy to replicate. Effectively, when the market is down, you say relatively we're doing better initially, but eventually at some point, hedge funds actually start losing money faster and faster. Relative works when the S&P is down 10, 20%. S&P drops more, then you start seeing massive drawdowns and massive multiples of volatility in drawdowns. On the way up, you say, hey, we're a hedge fund, the S&P is beating us. On the way down, you say, oh, on a relative basis, we're doing better than the market. You get paid 3% a year, 2.5% a year in fees.
It's a nice game. This extends beyond just hedge funds. This is private equity and all kinds of venture capital, right?
Correct. I'm going to say if there's a holy grail today, the fact that risk is not linear. If you look at a hedge fund, you look at its correlation to the market, you look at a hedge fund, you look at its beta to the market. On the way up, hedge funds make less money than the market. And on the way down, they start to correlate more and more to the market. So effectively, the risk is not constant. And the less constant the risk is, the more short option like they are, the more alpha you generate. How can you do that? It's basically by trading illiquid instruments, or as I said, hedging the principal components of risk. So you're taking risks which are the major beta risk of the market is hedged, but the other ones are also correlated to the market. In fact, they're not active in everyday life. They're only active when the market is dropping. It's like a risk transfer mechanism, and you get paid tons of money doing it, especially in an environment where the Fed is giving you that put, which is so powerful. You can write your own put on top because you're protected by the Fed. It doesn't make sense.
Let me drive a little bit more here. You might have to be careful about how much you want to say, but for these hedge funds to get to this point where they're running these, quote, their strategies are all the same and they're not really even beating the market. And on the way down, they're not doing necessarily better than the market. But it takes two to tango. So there has to be investors that believe in these people. On the flip side, if they are, whether it's institutional pension, whatever, these people should know that a guy like you expresses the opinions that you express. However, it doesn't really affect their decisions that much because they keep plowing the money in. Can you explain to listeners out there why investors and who these investors might be that go along with this routine, this typical hedge fund routine? Why do they go along with it? Who are they?
Listen, when you're managing money for other people, typically you want to show that you're more stable than the market. Let's say simplistically, you write puts on the S&P instead of going long the S&P. So effectively, for a while, you look more stable than the market. But then if the market drops a lot, which happens every 5 to 10 years, you have to write a nice letter to your investor saying, sorry, blah, 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 this happened. But most of the time, it looks like you're much more stable than the market. If you're an institution, if you're basically managing money for others, which in today's world is 99.9% of assets out there are managed by institutions, they're not managed by the actual owner of the assets. I'm going to say there's a conflict of interest that the tail, which is highly, highly impactful to the end investor, is really not impactful to the institution that's managing the money. Effectively, if I look better than the market for 10 years, if it's more stable with a higher Sharpe ratio, then I can justify my fees. Now, if every 10 years something bad happens and I have to justify it, typically it's worth the risk. Especially you look at these hedge funds, all these PMs that go around, and effectively they're taking tail risk here and there. It blows up, they go to the next hedge fund. And there's so much capital around, so much capital, and people are looking for, when they say we're looking for something which has less market risk, these hedge funds look like they have less market risk. For a while, as the market is making new highs, the correlation to the S&P is typically low. It's like 0.2, 0.3, 0.4. Therefore, it looks like less risk. It looks like returns which are slightly lower than the market, but people feel like at least they're not taking market risk, which is very, very false. It shows that the market risk is hidden. really it looks like it's a separate investment. It doesn't look like very market correlated. And second, the misalignment of interest where the end investor really cares where he's going to end up in 20 years or in 10 years. The intermediary doesn't really care that much. The intermediary is interested in keeping the assets for a long time and to earn his fees. It's a game which is self-perpetuating.
As you make that point, I'm thinking also, too, if these time horizons are 10 years plus, perhaps, then you have career turnover, career change in staffing, and then it just becomes the next guy's problem. And so these huge piles of capital could have, I don't know how long a manager or the decision makers hang around, but that things just keep moving on. And then the end investor, I guess they're just trusting the system, so to speak. The firemen and the teachers, et cetera, they're just trusting that everything is going to go along, and then wham, bam, thank you, ma'am. As you point out, it's these steady returns. I always say that if I see a track record that shows me that it's making 1% a month every month for decades, I either have Madoff or long-term capital management.
Absolutely. Actually, for us, we measure risk not through volatility. We're saying today volatility does not measure risk. Don't even bother looking at volatility because that's not what you're getting paid for. That's why you have such variation in the Sharpe ratios of hedge funds. The real thing that you're getting paid for is tail risk. Effectively, you can say I can measure the tail risk of a hedge fund to see how much Sharpe ratio or alpha return I should expect. Or what we say actually is don't even bother looking at the convexity, just look at the Sharpe ratio. Effectively, Sharpe ratio and convexity are 80% correlated. All we're saying, the steadier the return, the bigger the tail risk with 80% correlation.
I'm going to let you get into convexity in a second because it's a buzz term. No, it's academic term a little bit. But once people understand it, it's a quite important concept. But first, I want to take you back in time a little bit because if I look at your career, you look like a persistent guy. You keep grinding. Give for my audience an understanding of where you started and where you are, because you definitely didn't start with the quote silver spoon. You definitely have grinded it out to get to something that's quite successful.
Definitely. I mean, I didn't have this big finance pedigree. I never worked for a big firm. I mean, I worked for a small hedge fund for a couple of years. For me, we started in 1999 with 3 million under management, literally. We went through a cycle where we grew to about 600 million, and we started in 99. The first peak in assets was about 600 million in 2008, 2009. Effectively, 90% of our assets came from one large CTA, a fund of one large CTA. I won't mention the name, but they're UK based. In 2010, they redeemed.
You didn't necessarily like that feeling. That was the world that you were in. You accepted it, but you always knew it was not a perfect situation.
They're highly sophisticated and they understood what we did very, very well. Not only our returns, but our alpha, so our relationship to what's going on to volatility and what's going on in the S&P and what's going on in some very specific things in the market. Because they understood us so well, we had, I would say, a full sense of security. We never expected that this firm would actually get hit in 2008, or at least their fund of fund would get hit to such a large extent. They had investments with us, but they also had investment in credit and other liquid things. Effectively, they needed a lot of cash and very quickly, and they had to redeem us to meet their cash needs. We were almost like servicing one highly sophisticated client, but we didn't have to build a business. It was great because we got to focus on research. It wasn't so great because we didn't really build an asset raising infrastructure. We didn't have demanding clients who were like, hey, where is this? Where is your CFO? Where is your COO? So the business was run very, very lean. It was basically great research years. And to interact with that type of client, you also learn a lot about the industry and all kind of things. Now, when they redeemed in 2010, 2011, our assets dropped back to like 40 million. Not only did we lose 90% of our assets, personally, I was invested in the program. 2009 onwards, our returns were weaker. Very, very difficult period. And we had no money, so I had to basically fund the business and put cash back into the business to keep it floating. Philosophically, for me, I'm not looking short-term at my results. I'm looking for the long-term stability. If I was looking to have month-to-month high Sharpe ratio, I would have said, you know what, I'm never going to make it. But my expectations are more that at the end, I want to be the guy closer to the top. What happens in between, I really don't care that much. As long as my expectations are reasonable, I can have more stability long-term by allowing for short-term instability or what looks like short-term instability. So always the business, I knew that in the long-term market cycle, when the volatility actually kicks in, I'll be on top. I'll make new highs and all kind of things. It was this very long-term perspective. For me, the results, I do what I can do and I try to add value every day in every aspect of the business and all that. If every day I'm doing the right thing, I believe that long term I will add the most value. And that's what I did. So I didn't really focus on the fact that we lost 90% of assets and the business was bleeding money and all that. I just kept going. If I was very attached to the results, I would have easily given up. Every day I went to work with a very open mind. I always told myself this business started at zero. We had no assets when we started. And one day it's going to go back to zero. Maybe today, by the afternoon, I'll decide to shut down the business. It was too difficult to think of next week or next month, etc. I said, let's take it day by day. And then day by day, I was able to say, okay, today went well. We're still in business. Great. Tomorrow we're still in business. But I kept an open mind. I didn't have this rigid mental attitude that things have to be great all the time and things have to go my way and have to look perfect. That allowed me the flexibility to go through very, very tough periods where most of my peers would have given up, or they would have modified the models to be adapted to a market regime which is highly unstable, which is the S&P going up and the vol being low and bottom ticking and risk parity and all the things that were really working well that we've written about in our research. Having a long-term perspective is very, very important.
Once you get to that perspective, though, that entrepreneurial perspective, which is what you just described, fund management trading aside, that entrepreneurial perspective, it's so deep in your bones. It's deep in my bones, a different type of business, but you can't go back. You can never be an employee again, I don't think. You're done. You work for yourself. You enjoy that feeling. You like the struggle. You can't escape that. That is you. And that is probably why, I'm guessing, clients, people you work with, they want to be with you because they know you can't escape that. You're driven to that.
Really being accountable 100% for my actions and getting direct feedback from the market. I want that voltage. If I do something which is great, I want the market to, at some point, reward me for it. And if I'm not doing well, I want the market to tell me as well. For me, it's the fun and the learning and the growth, the evolution of what we do, the levels of complexity that we keep adding to the business as we grow from 3 million in 1999 to we're close to 3 billion. The fun part is the learning. That's what I enjoy, and this constant process of evolution. The entrepreneurial spirit, in my opinion, I'm here to serve. Whether I'm serving a corporation or I'm serving large pensions, I'm here to serve. I feel more comfortable in an entrepreneurial environment where I can set the tone, I can set the culture. I'm more likely to succeed when the culture is something I set than in a culture with somebody else set. Also, I'm more likely to set the strategic goals correctly in line with my beliefs so that if I'm trading something and I don't believe in the high level strategic direction of the business, I'm going to have a much harder time being fully dedicated and fully creative. My father, when I was a kid, used to tell me, you're better off selling newspapers than working for a big company. So the first chance you get, start your own company. It doesn't matter what you do, but at least your feedback loop is much faster, is much more exact. I went with that philosophy. It seems to have worked. It's possible that in some environments, entrepreneurship will be much more difficult and large corporations will rule the world, etc., and be very hard to compete. But luckily, in the business that we're in, I was able to stay competitive with the large firms, and today we're a decent business.
Let me shift you into something topical and see if you have a view on this. And after I ask this question, we're going to move into some models and some convexity. But there's been a lot of interesting news in the last month, particularly a young investor down in the Bahamas. You are in a world where you are highly regulated. You understand what the rules are. You understand if you break those rules, okay, maybe somebody escapes scrutiny for a long time like Madoff. But basically, there's a certain amount of transparency. You play by those rules. How do you feel when you watch something unfolding with SBF? How do you perceive that and what's unfolding? It seems rather unusual, to say the least.
It's normal considering the sentiment in the market. There's so much cash around. There's so much money floating around. What you see happening in crypto and all the money that was made and all the money that was lost, all the guys that were sitting in cafes all day, drinking coffee on their laptops and making millions and all that, that's one aspect of a massive money printing market regime that we're in. It's not unexpected when you have bubbles of the size that we have, when there's so much paper floating around compared to the real economy. You're going to have asset bubbles right and left. The fact that this one grew so quickly, that it was so unregulated, the regulators are very, very slow machines. They respond to problems. They have a hard time predicting them. The industry itself obviously would rather not be regulated, so the industry is going to try to defend itself. In particular, something like crypto, which is being sold as a way out of the system, as a way to be independent from the fiat money system. I'm not surprised that it would happen there.
It's the bigger issue of too much money. So it's not surprising that too much money finds its way to some particular individuals on some particular, perhaps, scam. That's not surprising.
Yeah, people are here marketing new cryptocurrencies. That's the opportunity that's available when you have this much money around. People don't need to be as diligent in terms of where they invest. If the opportunity is to make 500% a year, 100% a year, et cetera, which massive returns like crypto had, you say, hey, it's worth the risk. Everybody said it's worth the risk. People maybe didn't think as much. Maybe they gave 1%, 2%, 3% of their assets, hopefully not more. Obviously, the younger you are, the bigger percentage of your assets you typically would have invested in crypto. People didn't take it very seriously. It's like, what's the big deal if I lose 3% of my assets? 3% of your assets, everybody does that. Next thing you know, something which had normal market cap is 10 billion market cap. It's expected.
It's expected, but unfortunate.
What I'm saying is it should be a lesson for what could come at a bigger scale. That's what's unfortunate. People are not seeing that when you have financial markets be 2 times the size of GDP, you're at all-time highs, and this is what's called the Buffett ratio. Effectively, the real economy is not growing in parallel with paper markets, and that's a very, very dangerous situation. It's an economy which is so over-leveraged financially that even small corrections in the paper economy, in finance, in the market cap of equities, would have very big impact on GDP. When the size of the market cap of equities is 2 times GDP, the market goes down 1%. That has the impact of reducing money supply by 2%. It's massive. Today, we're in a place the Fed, by encouraging this paper growth, has effectively said, don't worry about the real economy growing as much. We're more interested in maintaining a financial system which is stable, no matter what the underlying fundamentals of the true economy are. That's what we're being told. That's what's happened for 2 decades now.
Let me shift you into the real operative question for me. I'm sure I've asked this of you before. When is the moment where you had your aha moment for the first time, where you realized, well, you were just giving some opinions about the Fed and money supply, et cetera, and bubbles, but your day-to-day isn't necessarily that analysis of that. Your day-to-day are models, and many of those models are based on price. When did you have your first aha moment of, hold on, I can try to analyze all these macro events, I can try to analyze all these fundamentals, but if I look at price, I've got something. When did that first happen for you?
When I was 23 years old, at the time I used to read a newspaper called Investors Business Daily that made pretty wild claims about their system of ranking stocks and all that. I had a PC and I started testing their claims. Most of their indicators were used to time the stock market overall. I took the indicators that they provided and tested them one by one, and saw that they effectively had no value on a return to drawdown perspective on a risk-adjusted basis. Eventually, I started reading books on trading. Eventually, I read a small, tiny little book about volatility breakout, not Toby Crable's book, but someone else's who had worked for him. I became acquainted with what's called volatility breakout. From there, I saw an incredible opportunity, and I understood that investors are measuring risk in the risk monitoring mechanism that most investors are using is inappropriate to measure the true risk in the market. You're only measuring one very, very limited aspect of risk. Standard deviation of returns, or what people call volatility or value at risk, effectively is measuring one type of market movement. You can have a market go up 500% and standard deviation can be 0. So if a market goes up 10% a day, standard deviation of return is actually 0. There's no variation around the mean return. The fact that it's going up 10% a day will have no impact on volatility. Effectively, risk equals 0. Take massive risk and pile up into the market. How is that possible? Something which is up 10% a day is highly, highly risky, and it's not being captured. Tail risk is not being captured by the...
Are you telling me that I should not be worshiping the Sharpe ratio?
In this environment, Sharpe ratio works for the beginning of the market cycle, but with the full cycle taken into account, it typically doesn't. Sharpe ratio is a predictor of tail risk. Sharpe ratio effectively predicts how big your drawdown is going to be as a multiple of volatility. The higher the Sharpe ratio, the bigger your peak to trough loss as a multiple of volatility. Effectively, high Sharpe equals high tail risk. From there, when I said, okay, there's a massive opportunity that people are being lazy in the way they're monitoring risk and the way they're risk budgeting. And there's an opportunity to, in a way, arbitrage that, to trade the breakouts when the volatility is low. There's places where you can actually go almost like long an option in a way which is much cheaper than actually being long the option itself. I said, hey, this is great. I'm going to do this. In particular, for me, it actually matched my longer term perspective. So I was talking about my macro perspective. My macro perspective is not important. My historical experience in life, growing up in the third world, seeing hyperinflation, seeing paper money effectively losing 10% of its value, that's very, very impactful for me to see what the possibilities are for the long-term market cycle. And that effectively guides research. That's why when we're doing research, we're effectively risk normalizing based on tail risk, not on volatility. What I'm saying is my macro perspectives, although we're not trying to predict the market is going to go up, it's going to go down, it tells me that take into account the very long-term cycle and what's going to happen in 50 years, not only in the next 10 years. Be ready to handle very, very large tail events. That's very, very relevant today.
I'm looking here. I've got something I just jotted down. Large returns, small losses. Small returns, large losses. Those simple expressions, large returns, small losses. Small returns, large losses. We could teach an entire 4-year college class on that. All the tangential aspects to that, because the notion of large returns, small losses, this is not something that people want. They want consistency. Whether that's at the institutional level, the individual retail level, they somehow or another, and maybe it's just human nature, have imagined that consistency is the goal. Somehow or another, we can look around the world and can realize that nothing is consistent, but the markets, which are simply made up of more people, those should be consistent. And when I want the magic money machine to give me money, I want it consistent. It's really amazing that we can imagine this consistency when there's no evidence for it.
We're being sold something very different. We're being sold that this is an economy where consumers and you can have anything you want at any point. You can have ketchup delivered to your door within 10 minutes by going online. Everything is immediate reward. Anything you want, you can have. It's the same in markets. If you desire to have consistency, you can have it. The reality is different. The reality is there's a real economy, and to have consistency and to have growth, you need to be productive and value add. That's not what we're teaching people. Our whole economy is falling behind the rest of the world, and we're trying to play games with the paper surrounding it in order to make it grow. Eventually, the real economy is the ultimate truth. It's unfortunately, in my opinion, in real terms, shrinking.
You brought it up a couple of times with the printing and the bubbles and whatnot. This is not a question to try to get you to make a prediction. That's not my point. But if you were to explain to people in a little more detail where we are in the quote market cycle in terms of looking at the imbalances, and you've mentioned tail risk multiple times, and that being ready for tail risk, it does seem like a moment in time. Let's assume someone has no market knowledge. They look around the world at various events, US dollar going up, Japanese yen going down, trouble in China, trouble in Europe, energy prices. It seems like intuitively that people would realize these are really extended, unusual moves happening in multiple countries. Yes, things are related, but they kind of look unrelated. Then at the same time, you've got a media machine telling everybody, it's okay, we're close to all-time equity highs. It's an amazing time period.
Well, if you're here and you're in a business of printing money, which I would say that's the most major business that we're in today as a country. I mean, we print this money and we distribute it all over the world. The story that's being told is part of the marketing machine. Just to give you a sense of equity market cap to GDP, the Buffett ratio, on average, it's around 0.7. Recently, it was around 2.2. We're about 3 times higher than the peak historical average. Today, it's back down a little bit, around maybe 1.7. That's how much paper there is relative to the economy. The way inflation actually hits is You can control paper markets by printing and all that. You cannot control real commodities, right? You cannot print real commodities. Unfortunately, you have to compete with other countries in terms of what you pay for them. Countries that are more productive or have a truly growing economy are going to want to pay more for those real commodities. We're in a place today in the world where we depend on the rest of the world for a lot of things that are in the physical world. There's so much money around, people are willing to pay anything to get those things.
You mentioned earlier you growing up in the third world.
Mm-hmm. Mm-hmm.
Where did you grow up?
I was born in Beirut, Lebanon, actually, just before the war.
The reason I bring that up is I guess some would say that a place like Saigon is still the third world. It's moving up the ladder quickly. But I think what's interesting is when you talk about, I don't know if this would apply to Beirut today, but around the world, a lot of people, whether it's, if they don't trust their home currency, it's not unusual for people to want to have, whether it's physical gold or Ben Franklin's in the wall somewhere. There's a real trust of the American dollar. They see that in terms of purchasing power and their own home currencies being debased. I always think it'd be interesting, though, that maybe some of the people that are in the, quote, third world that have not had a chance to visit America, that if the rest of the world had a chance to fully see the picture of the inside of America, how people are living and whatnot, if the rest of the world would believe in the dollar so much. What do you think?
For now, the dollar is a better currency than the other currencies around the world because it has the benefit of having...
It's the tallest midget.
It also has the US Army to defend it.
Sure.
If a country wants payment for its oil in other currencies, it gets invaded and the next regime is put in place. Not that the dollar doesn't have weaknesses, but I would say it's still a strong currency, but not because of the economy or monetary policy, but more because of the strength of the US Army and the impact that we have all over the world.
Fair point.
That's the major difference. We can print faster than anyone else and still effectively not devalue, or we can control the devaluation.
Let me bring it back to models. Do you try to, at this point in your life, and look, there's some primary models that you guys trade, but when it comes to looking at strategies and analysis, you're attempting to model everything. You want to model it. You want to create an automated system, so to speak. That's your edge. That's what you've figured out.
Yeah. Markets are about supply demand. We all read the same news. Then we all have biases, which are very, very difficult to perceive. Requires a lot of self-awareness to be aware of your biases relative to the common mindset of the market. Models are a way to protect you from thinking like the crowd. It's a way to find these very, very little quirks in the way that people think, their overconfidence relative to historical norms, and to take advantage of them. It's very difficult. The amount of data that you have to analyze, it's impossible for the mind to do this. The mind can handle these new pieces of information here and there better than a system, but the moment you can automate something and think of it systematically across markets, across time, you're going to have a much deeper perspective, a much richer perspective on factors that are driving the returns in markets. So no question, I mean, as an individual investor, I'm a retail guy. I don't know how to invest personally. The models are driving returns 100%. The models look at nothing but price. Nothing but price. There's zero fundamental information. We're not participating in the game of digesting fundamental information and setting price accordingly. We're purely reading market price, saying what are the inefficiencies that we can see through price. Through price, of course, we calculate all these different aspects of volatility and we try to arbitrage those. What is the volatility of a market when it's making new highs and new lows versus when it's in the middle of the daily bar? Really quirky little things that help you predict extensions of the moves and things that other people don't typically see just because they have other things to worry about or their edge is elsewhere. We have this very particular edge. Over 20 years, it's evolved incredibly. It went from systems being optimized on a per market basis to more complex systems, different ways of measuring volatility. Today, we're one step beyond all this. We have all these factors that we run, all these alphas, and we're actually predicting not what has worked, but what is going to work in the future based on what the market is doing today. We're predicting the market regime shifts from this current market regime and what's working today, what is going to work next. What market is going to attract too much capital? A system that has a Sharpe ratio of 1 is going to become -1. We're predicting asset flows and how market characteristics are going to change across 4 different dimensions. Effectively, trading the breakouts or trading momentum, you can choose to trade one of 4 asset classes. That's the first dimension: equities, fixed income, FX, and commodities. You can decide to trade short-term or long-term. That's another dimension. You can decide to be trading in certain markets versus others within an asset class. You might want to be long US equities and short European equities. That's a third dimension. And finally, the fourth dimension is there are many different ways to trade volatility or momentum. You can trade channel breakouts, you can trade moving averages, you can trade price momentum, price today relative to price a year ago, or you can trade volatility breakouts. So if the market moves a certain multiple of volatility, you go long. And if it moves down a certain multiple of volatility, you go short. So these 4 dimensions of momentum, we're playing an arbitrage in these 4 dimensions, saying where can we get the cheapest possible trends, all based on price. It's all derivative of price on top of derivative of price. So we're finding all these quirks that are telling us trend is cheap here and it's overdone there. It's almost like a statistical arb strategy within the momentum space. It's learning how to learn. It's predicting how people are going to react to the market based on the historical returns. That's the real edge. If you hire 100 quants, they'll show you models with Sharpe ratio of 1 minimum. You give them capital, you'll see that maybe 5 out of 100 make money. It's not the fact that they over-optimized. It's the fact that what is working today is going to attract capital. Markets are much less liquid than most people assume, and there's going to be a market regime shift. Markets are much more responsive to what people are doing. The market regimes shift so aggressively. You go from low vol to high vol. You go from a certain type of noise to a different type of noise. And we're trying to predict these market regime shifts. It's a question of second order thinking. It's not a question of optimizing or being a good researcher. It's predicting the shift in thinking.
What's interesting is you talk about that shift in thinking. I'll share a quick story. Someone emailed me the other day and they were expressing thanks for, I don't know, maybe they read one of my books or something and they were introduced to the concept of trend following. I guess they somewhat got unlucky that they started this year and maybe they made an allocation to somebody and they're up pretty big coming into, I guess, the last month. The way the individual said it to me was, thanks, this has been really great. It's been a great year, except for the most recent drawdown. It was almost like they understood, or they said they understood this idea of trend following. They'd had a good year, then was lamenting some recent drawdown. Like somehow or another, they had come to think that trend following only goes up, that you only make money going up in trend following, and there's no down periods. It was the same thing that they might have applied to buy and hold the S&P, and now they were applying the same thinking to trend following, even though they were expressing they understood what trend following was all about, and you're not going to have this consistency. Humans can't help themselves. They want to reach for that consistency again and again and again.
Yeah. There are ways to numb pain. The more you numb your pain, the more out of touch with reality you are. People can keep their minds busy watching TV, this, that, but at some point, you got to sit and look at what's really going on in the world. It's the same with markets. I would say the more difficult and the less justifiable a position is based on the information available, the more alpha that position will give you. If you look into the market and you find all these reasons, all these justifications for a position, for a system, for an allocation, the less likely you are to produce alpha. The things which are fed in our brains and the way our brains are wired to think, you have to design models that do exactly the opposite. There's first order thinking, which is like retail. Second order thinking, you can say, is almost institutional. Then you have to go to another level beyond that to think how to be one level ahead of the institutions and their ways of allocating money.
You made a point earlier about we're all looking at the same information. And I was thinking about, I've enjoyed watching Elon Musk's recent tweets where he's explaining how he's trying to build his new Twitter business. It's quite fascinating to see he's giving a little transparency, probably not a lot, but a little. So it's fun. I think what's interesting when any of us look at any particular individual and we read their posts or their tweets or whatnot, we have this feeling of, oh, we're getting some information, some inside information. We know something. Well, hold on. Elon's got I don't know, 100 million followers. There's nothing inside about it at all. It's just, everyone's getting the same thing at the same time. And I think that's the point that you're making is across this conversation is if you want to find edge, if you're looking at the same shit that everyone else is looking at, you're not going to find edge. You're just going to be entertained, I guess.
In markets, you have to be differentiated. It's not a question of you can be super smart, but if everybody is as smart, has the same reasoning, you're going to end up losing money very, very consistently. It's a question of understanding how differentiated you are, not a question of understanding being smart. Intelligence goes only so far. You have to find ways of systematizing your differentiation. That's really key. It's not a question of higher intelligence.
You hinted at some things early on, but do you have any particular influences when it comes to individuals that have influenced your career? Or was it mostly a self-taught process you went down?
I have over the years, a lot of different people were very influential. In the early days, Toby Crable, some of his work on volatility breakout, Perry Kaufman and those books. Later on, it was more like the big hedge fund researchers and all their work was influential. Today, we're in a place where I would say the limitations that I'm dealing with are more on the management side of the business and how to create a culture and all that, the likes of Ray Dalio. And then in the spiritual realm, having the right mindset, the right philosophy, the right expectations, not to have high expectation, allowing yourself to feel pain. A lot of these things are the people who teach these type of philosophies are the ones that I follow. There's people who are extremely advanced in all fields of life. And today on the internet, you have access to their very deep thoughts. They might not be popular, but you have really incredible access to them. And if you're not sitting passively and watching what's being offered to you, I have many teachers. In my office here at home, as I said, I see piles of books on top of bookshelves full of books and piles of books on the floor, on my desk, everywhere. And for me, I want as many different perspectives as possible. Some of them are great, but they're still useful to know what other people are thinking. My understanding of the world is ideally I can think like an expert in every field by reading their books and understanding their thinking. I can adopt a way of thinking. I'm not attached to the ways I think. And that's really key. Today, the world is evolving so fast. You have to be able to give up massive amounts of assumptions that you've made and things you've learned in the past and use new ones because the world has changed. For me, that's the learning mindset is really key.
I'll share with you really quick. I've spent basically the last decade in a Buddhist country. I'm not saying I'm an active practitioner or studying by any stretch of the imagination, but I'm around a lot of people that are. By the process of osmosis, I find it interesting to look back at myself to realize how much of a shift has happened in me, an unexpected shift. I didn't fight the shift, but an unexpected shift. And I appreciate, I think you already understand where I'm going, but for a lot of people that have not had those kinds of experiences, it is quite nice to find yourself in that kind of environment. It really does change you.
Absolutely. There's a certain humility that comes with Buddhism, which is tremendous. For me, the more I got educated in Western schools and Ivy League schools and that type of thing, the more arrogant I became, the more confident I became of my thoughts, the less I could learn. Eventually, I became so rigid that I couldn't function. I couldn't add value. At some point, by chance, I landed in this Zen retreat in upstate New York. Basically, the practice is, from a linear perspective, so difficult, so painful physically. It's almost I had to give up everything that I knew and start again. That's, I would say, the first experience of, you know what, everything I know is not relevant. That's kind of like something I've put in there, and I can choose a completely different mindset. I became detached from my thoughts. In Zen, they say beginner's mind. Can you really see the world like it is without preconceived notion? I would say Buddhism is a great philosophy rather than a religion, a great philosophy to keep this flexibility and humility in front of reality so that you accept things like they are rather than impose your thoughts on the world.
It works well if you become a system trader or a modeler. They dovetail well together, don't they?
Yeah, you have to accept that you have to go through so much pain, basically surrender control to the parts of you and the parts of the system that are actually the ones that are adding value. And you have to quiet the rest of your mind so that it does not interfere with the discipline that is required to follow the systems. So yes, for me, it's a must. I've been practicing meditation since 1992, almost daily since 1996. it's a critical part of what I have to do to be ready to go to work and to think like a systems trader.
Nigel, great stuff. Again, we have to have more regular conversations. This podcast has varied so much over the years, and many times it expanded beyond trading. This year, especially, I have felt myself wanting to reach back and talk to so many of the smart people that came on, perhaps early on. And I drifted to all these conversations beyond trading. But I guess this has been one of those great years where it's like, I got to get all those systems and trends guys and model guys on. It's such a great year to have these conversations. Hey, Nigel, where can we send people? At questpartnersllc.com? Is that the main place?
Yep, that's it.
Anything else you want to say? I bounce you around to a lot of different things.
Michael, I really enjoyed the conversation. I think that we're living in an incredible period in the US, the level of prosperity, despite some underlying weaknesses, but it's an incredible period to be alive. This incredible opportunity. It's an amazing time to be active in this business. I hope your listeners are persistent and are doing what they want to do. There's really incredible opportunity out there. I'm just, I guess, in a way excited for everyone. I hope people pursue what's in their heart and be great at it and be successful at it. There's just a lot of resources and possibilities today.
Great stuff. Let's continue the conversation. Have a great evening. We will talk again, sir.
Thank you, Michael. Thank you so much.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.